Now let's discuss the Unit 13 post-lesson assessment on taxable incomes and tax brackets. Question 1. What is your gross income and where can you find the gross income earned from a job? So the gross income is the sum of all income that you've earned over the year from your job, and it will be on your pay stub under the year-to-date earnings total section. If you want your gross income for the year, you have to check this section on the last pay stub of your year. You will also find this on your W-2 form or your 1099 form. Next question, what is the pre-tax payroll deduction? Money withheld from your paycheck to pay certain benefits or taxes is called a pre-tax payroll deduction. This is the reason why your gross pay looks less than what your job offer has listed. And it is an example of something called non-taxable income. What are adjustments? Where can you find out what adjustments you qualify for? So adjustments are expenses that reduce your taxable income. Some examples of this include tuition, student loans, and educator adjustments. Very, very importantly, if you are a boss, health insurance, Social Security, and retirement contributions count as adjustments because they're not automatically put into the pre-tax payroll deductions for bosses or contract workers. The Tax Form 1040 will help you calculate any of your adjustments, and there are also online apps that can also help you figure out what your adjustments are. What is the AGI? And what happens if your AGI is low enough? And why is it important to keep your AGI as low as possible? So your AGI is your adjusted gross income. It is basically your gross income minus the adjustment. If your AGI is low enough, you can qualify for various itemized deductions and tax credits. The more adjustments you do, the lower your AGI, and the more tax credits and itemized deductions you can have, which will lower your taxes even more. And I will say this again, the more adjustments you claim, the lower your AGI. The lower your AGI, the more tax credits and itemized deductions you will qualify for, which will lower your taxes even more. What is the difference between a standard and an itemized deduction? Well, a standard deduction reduces your taxable income by a set amount, which is set from year to year. The advantage of just taking the standard deduction is it's quick and easy. You don't have to calculate anything. An itemized deduction is basically you nitpicking and parsing out every little individual deduction and then adding those together. These can be things like medical bills, mortgage interest, disaster damage, if your house was damaged, your property was damaged, all that can count. But you can only choose one. You can choose either to take the standard deduction or the itemized deduction on your taxes. What is taxable income? Taxable income is your AGI, your adjusted gross income, minus any deductions or tax credits. What is a tax bracket? And what is the marginal tax rate? So a tax bracket goes back to the idea that we are a progressive income tax system. Taxes are divided based off of your taxable income into tiers. The tiers are a little bit more punishing if you make more money and much less punishing if you make less money. Essentially, with the tiered system, it applies a percentage of taxes to each tier. These percentages are the marginal tax rate. Recall that your tax bracket is based on your taxable income, not your gross income, not your AGI, or not your net income. It is your taxable income. Now, how does the marginal tax rate work? It doesn't quite work the way you think. Each tax bracket must be filled completely and taxed at that tax level with the first amount of money, then the second amount of money, and then the third amount of money, and so on and so forth down the tax brackets. So say, for example, the first $10,000 is taxed at 9%. It doesn't matter if you make far more than $10,000. 10,000 of your dollars will be taxed at 9%. And then it rolls into the next bracket. Say another $30,000 will be taxed at 15%. Well, for everybody who gets into that bracket, that amount gets taxed at, the 15%. Now, say, for example, you only partially fill your bracket, which is exactly what happens at the end when you're calculating up your brackets. Well, for that fraction left, that's your tax bracket, that's your final tax bracket, and you pay whatever percentage only on the money that fits into that bracket after having filled up every other bracket. So say, for example, if you have there was an example that was given in the lecture series where we had a little bit more than $10,275, and the first $10,275 was in the first bracket and was taxed at 10%. Regardless of the fact that the rest of the money spills over into the 12% bracket, the total money isn't taxed at 12% because the first $10,275 will be taxed at the first bracket rate, and only the remainder in the second bracket rate will be taxed at the second bracket rate. Thus, the marginal tax rate is the rate of taxes really only on the very last few dollars of your income to fall into a tax bracket, and rather not your total tax burden. I will bring up the example for you to see for this in just 1 minute.